Hi guys, welcome back to Bag Holder Pod. Today, Chicken is not around because he went overseas to have fun. So, for this episode, we will be talking about CPF changes. So, many people are expectedly very angry about this change because first, there will be no more CPF SA after 55 years old. So, there's a huge loss of 4% interest downgrade to just 2.5%. So, let's say if you have like 600K in your CPF SA, 600K downgrade to 2.5%, you'll be losing about $24,000 free money a year. So, Eric, how is your retirement still intact?
Actually, I don't think I depended on the CPF SA. Like I top it up to full retirement sum and that's it. I didn't really bother about the CPF side anymore. So it's I don't know. I think my wife was a bit more upset than me because she really liked that 4% interest. Yeah, but I'm not so sure like I think maybe it will impact the people who depended on it like 100%.
Actually, this is the part that I find quite interesting, right? Because say for example, let's say if you are already, let's say 55 years old, right? And you are getting 4%. Then you are happy with that 4%. If you want to withdraw, you can withdraw anytime. Then now suddenly government take it away, right? Okay, I can understand that this group of people, they are very upset about it. But for those who are younger age, right? Say for example, like 30 years old, 25 or 35. This one is like that additional 1.5% is not something that, I mean, it's in from your current age until 55 years old, actually there's nothing, there's no change. What changed is just that at age 55, can you still continue to earn that 4% or not? So it's like taking away something that we currently don't have anyway. But why are people, I mean, the younger group of people, why are they upset about it, right? So I think that's quite interesting. It's like, I don't think it makes sense there. I mean, you can just continue to plan for it. It's like years ahead anyway, right?
It's like saying you never invest in Nvidia, then Nvidia go up. You miss the boat. That kind of feeling like you missed the boat. You didn't manage to get the benefits, to get the money from the government. So that's why people are angry.
And then the thing is, it's not like, I mean, 4%, if you consider that it is risk-free, it is liquid, you can't find any other alternatives. This one, I definitely agree. Actually, I also plan that, let's say, any amount above the FRS, I also plan to just make use of all these 4% if it is available, right? But the thing is, to get 4% return is not something that is very hard also, right? Imagine that this is not 4%, right? Imagine that this is like 7%, risk-free, liquid. Then it's a lot harder. Even if you take a lot of risk, probably you can't hit 7%. But then we're talking about 4%. I mean, global stocks market can yield us, like let's say between 7 to 10%, right? But you need to take a bit of risk there. And also currently, let's say bond returns, even let's say like, okay, Singapore saving bond is a bit lower, but let's say if you take on other, let's say corporate bonds, or you buy some bond funds, I also don't think it is that low. It's slightly lower than 4%, but you average out between the stocks and bonds, you can still get something that is close to 4% or slightly higher, right? But the thing is, you need to be comfortable to take on more risk. I think that's the part that is quite challenging, especially for those who never learn about investing their own money. They just, they just want to get money from the government. So I think that's a bit tough for this group of people.
There was some professor who got interviewed after this came out. He said that this was actually an anomaly. So because like it's hard to find this 4% yield risk-free some more elsewhere, and Singapore government was offering it for quite a while. I guess that's the main reason why they would want to remove this thing, because there's no way they can guarantee risk-free 4% forever. So then some people say, oh, it's because of people like Kelvin, Mr. Lu, Chris, and they go and arrow that MP who brought this issue up in Parliament, the CPF shielding. They say, oh, because of them, this thing got removed. But I think the bigger reason is because the government cannot guarantee 4% risk-free forever. So that's the main reason. Then CPF SA is just the shielding is just a collateral damage.
Yeah. Do you think this is like really like fair to everyone? Because actually the group of people that take advantage on this, right? It's not like, normal low income people, I know that there are people who have, like 500,000, 800,000, 1 million plus amount at age 55 years old, and they just, earn that 4%. And that 4% is not, is funded by someone, and in this case it's definitely funded by the government, right? So and it is like, it's not distributed well in terms of the government like funding. You know, what I mean is that government they have to pay an interest that is higher relative to the risk that the member is subject to, right? So, but they don't give it like evenly to everyone. Some people, they have like 1 million, 2 million CPF account, they benefit more, right? So from fairness point of view, I also think that this is this should be this is the right direction. At least that's my feel. What do you guys think?
Eric, why is your wife angry? She thinks it's not fair.
She's the one that have 1 million.
No lah, as in she wants to benefit from the risk-free 4% man, because she doesn't really invest a lot. So she wants to like use that to fight against inflation at the very minimum.
But she invested in you already. That's already risk-free, right?
Okay, that's another topic. But anyway, I was just looking at one of the shots from yesterday, YouTube shots. I saw Mr. Lu like what did he say? He said that now that they close down the SA, right, you should pump it like to the maximum 700,000. Is it the full retirement sum?
It's 400k, 426k next year.
Yeah, so he said pump it to that amount by 55, and then you can get back 4.6k, something like that, 4 point something every month. So it's like kind of take revenge for them closing the SA. Then I don't know. I felt that this was like it showed that you have dug yourself in the hole, and then you dig the hole even further. Like, because they can close down this SA, obviously they can tweak the payout also, right? Depending on how many people make use of the loophole.
Actually, it's not loophole. That one, he's talking about the CPF life, right? So the uncertain part is how long can you live? Because if you know that you are going to live to 110 years old, right, then definitely you get into any sort of annuity also is very profitable, because how much you get depends on how long you live, right? But let's say if there's, like after you get into this CPF life and then just pass away at like relatively younger age, right? So you lose out lah. So that's how people hedge their longevity risk, right? So his logic is that, okay, I just put in more into this, and then my plan is I get it back a lot more by staying longer, But the staying longer part, is that something that you can control? To some extent, yes lah. I mean, living healthier lifestyle, you can do something about it, but it's not an absolute control, right?
He did the calculation. So the yield, right, is about 8.73% fixed based on your 65 years old amount. So from 55 years old is 426k compound to 65. Then the 4.4k, let's say you start the payout at 70 years old, the 4.4k you will get for the rest of your life using the standard CPF life plan. So that's the yield, the 8.3%. That's actually quite high. Quite high. Like, you can't even get this kind of yield from the S&P guaranteed yield lah, obviously. You can't get this kind of guaranteed yield from the S&P 500 forever. And now CPF they are guaranteeing this yield. Okay lah, it's obviously not guaranteed, right? It's on their website. They are not guaranteed, but that's what indicated lah. So you can more or less expect plus minus of this amount. 4.8%. Obviously, the government increased this ARS thing is because they are motivating you to top up even more money into it, ma. So just wondering if you guys would want to top up more money. Obviously, if you don't have a lot of money, the first choice would still be invest in the stock market, ma. But if you have a lot of money, like 2 million, 3 million, like Eric, then will you consider CPF Life as your second investment?
I basically won't, because it's still controlled by government instead of yourself. Yeah, so the primary consideration is, okay, it is stable, but beyond that, I will want to control my own investment. It's the same idea if you buy group insurance versus private insurance. So for a long time, I think I bought the SCF Life. Then after that, I switched to private. That's the rationale, because I can control the term policy.
For me, I think depends, right? Because right now, let's say like 400k, it looks like a 400 plus k, right? That looks like a big amount. Let's say if this amount is only a small subset of the total portfolio by the time I, close to like 55 years old or 60 years old, right? So I would say just allocate small portions top up to the four times BRS. I think that's okay for me. Just to hedge out the longevity risk, stable income. You don't have to manage so much, right? But still, you have another pot that's freely you can manage it yourself. So I don't mind to do that. But let's say if they keep on increasing the BRS, like they allow you to top up even more, right? Do I want to put, let's say, like 50% or 80% of my total net worth just into this kind of annuities? The answer is definitely no. Like you said, no, you lose out the control once you pass your money to CPF. I don't want to do that. But for small allocations, I think that's fine.
So if you go and calculate this thing, right, the 8% yield, in order to break even means you get to recover back all your money. Don't talk about the extra payout. You need about at least 10 years. So start from 70 years old, right? You need to live at least 80 years old before you can actually get back all your money from CPF and start earning more money from CPF. That money is actually from other CPF life members who have lost the game, right? They died earlier than you, so you are taking their interest. So, but the other issue is that like Eric said, right? If you want to control your own investment, you do your own investment then every year you go and withdraw out this maybe 4% safe withdrawal rate from your own stock portfolio. But there was one comment I see, right? He say that if you're like 70 plus years old, are you still able to manage your own investment? Like maybe Warren Buffett, right? He everyday drink Coke, but his mind is still very clear and manage his own investment. So at 70 plus, can you still do that or not? So that's the other consideration. Versus like CPF Life, every month, right, you see the money just come into your bank account and let's use this so-called free money that automatically comes in. So that's the other thing also.
Yeah, well, we are on this topic about how long you can live, right? Let me share screen. Eric, you have allowed already. I think many people didn't pay a lot of attention to this. So this chart here is showing the life expectancy. So we are talking about like when you get into CPF life, right? The main consideration is how long do you think you can live, right? The longer you live, the more money that you get. And many people will just say that, how long can you live? Probably 80, 85, 90. So is that right? Because actually we are not talking about today. Like today, what is the life expectancy, right? We're talking about, depending on how old are you, we're talking about like 20, 30, 40 years ahead, right? And if you look at the chart of life expectancy, right, meaning this is the expected age when people pass away, right? You see that since like let's say 1950 or even earlier, right, from 100 years ago until now, right, the life expectancy keep on increasing like steadily, and there are many reasons behind this, like medical and so on, right? And people also, I mean, in terms of lifestyle, probably also there's some improvement. So you can see that now it's at, let's say, close to 80. But we don't know, let's say 20 years from now, could these numbers be a lot higher, right? With all the, advancement in medical and so on. Let's say 20 years from now, people generally live to, like 110 years old. So that make a lot more sense to, like hedge your longevity risk than, because the main risk is not like you pass away too young, It's like, wow, what if I live until 120 years old? Do I have money to support my living costs? So that's something that I guess many people don't pay much attention to. That's an improvement in longevity.
But actually, CPF also hedge against this already. They say that if more people live longer, you'll give lower payouts. So your payouts will be forever, but you'll see your payouts slowly going down. Plus, there's also the inflation thing, right? So let's say if inflation is, let's say 2% a year, so your payout from 4K every year is going down by 2% in terms of the purchasing power. So let's say you go and drag it out for, let's say you live until 120, right? 40 years, you go and compound that by 2% inflation. How much your purchasing power has dropped by? So eventually this is still you can say it's a depreciating thing, the CPF life, the purchasing power.
So the conclusion is put enough, but don't put too much. Is that a valid conclusion?
Yeah, depends on your financial situations. I think one thing to remember is also all this CPF is not 100% of your retirement planning. It should be preferably should be a small subset of the total. So you should have other investments, right? But I wanted to circle back to switch gear a bit on these topics, right? Why do you think the government change policy on this? Is that because I heard that there's some rumors say that, oh, it's because government can't earn the 4%. So because the money eventually will be passed from CPF to the government, and then they'll pass it to GIC and maybe Temasek to invest, right? So is that because like these so-called fund managers, they are not able to even earn a 4%? Yeah, is that a concern, or do you think that this is just like speculation without basis?
So this is GIC's 20-year real rate of return. Real means taken inflation in the account lah. So it has been going from 6% down to almost like 4%. So I don't know. That time I show this thing, then Bundi say, oh, 不用紧的，没有关系. But obviously their returns are going down lah. So Bundi, what do you think about this?
Yeah, my turn to share screen. Okay, just now the one that you shown is the like 20-year rolling real returns, right? And then actually in this latest, this cutoff point is 31st of March 2023. This GIC report, you can see that their nominal returns, right, for the recent 5 years, right, is only 3.7%. This is not real returns. This is normal returns. So imagine that now, like if let's assuming that the CPF money is passed to GIC, and over the past 5 years, they only earn 3.7, but yet the cost of those money, right, they need to pay out 4%, right? Meaning that someone need to, like subsidize the difference lah. So I think that's why I find it quite interesting that could this be the reason that they don't want so much money, because they can't earn this amount of money?
Hey, by the way, Temasek Holdings, the returns are not actually published, is it?
Yeah, it's published.
Oh.
It's not the details. They have their own way of presenting it, but it's, I think they have more. I think they even publish the yearly returns.
Oh, but is their return better than GIC or worse?
Depends on horizon.
Their return is better because Temasek invests in a lot more riskier stuff. So that's why you were seeing like what's that, FTX, China, they got caught into it because they're investing in riskier stuff. So GIC is a lot more like sovereign wealth fund, so they can't go into risky stuff. But for Temasek, they are considered as a private company, which the shareholder is the government. So the government, they sort of earn from Temasek by taxing them. Whereas for GIC, they directly invest the government assets lah. So that's the difference.
Oh, okay. So the main thing is, who is managing our CPF money? It's mostly GIC, is it? 3.7 doesn't look like it's very sustainable. Okay.
But bear in mind that this cutoff point was as of 31st of March. So you remember 2022, it was quite a bad year, right? So that include, but this is 5 years average, right? So I mean, they were better years before that. So I don't know. It's like average out 5 years, 3.7% doesn't look good now.
But I also think you may say it's like that, right? They can't do they are losing money. They are losing money on CPF. You can say that. But on the other hand, they are also increasing the ERS payouts. So on the other hand, they are saying, oh, we have more money that we can pay you. So I think they are just moving this SA thing into ERS. So that's you can say, oh, the government is looking out our money. But on the other hand, they are guaranteeing your payout for the rest of your life. Right? Not guaranteeing, they say, oh, we can pay this, we can afford to pay you this payout for the rest of your life until the next change we make. So that's the risk that you'll be taking.
Yeah, I think exactly. This one really, I think the 4% to 2.5 is one thing, right? The one thing that shocked people is like, people has been talking about if you let your monies and let CPF to control it, right? There's policy risk. And in the past, when people say policy risk, people just say, oh, what is it, right? It's like it's very hard to imagine something that's not there until one day suddenly they just change, and then you realize that, oh, actually government will change this kind of thing. So I believe there will be a group of people who really didn't expect it, and they were surprised and caught by it. So, but once you kena one time, then you know that, okay, things like this could happen, like a few years down the road, right? So I think there's a confidence issues there, that people don't trust CPF more,
Eric, do you expect this thing to happen?
No leh. I was not that old enough, but I remember when I was very very young, right, like below 10 years old. My parents loved to put money in FD, and that time FD, if I'm not wrong, is like 5-6% when I was very very young. So I was wondering like, wow, the interest so nice. When I grow up, I also want to put FD, but when I grew up, the FD was like 0.9%. So it's I think the returns are the interest returns are always fluctuating from different time periods. So like our period is low interest, and then you need to take on a lot more risk to get the returns. So now it's like I think the government is realizing too many people are on board the CPF gravy train, so need to cut it out somehow lah. Yeah. So I also don't know, like, what do you think is the next policy change that might be possible if people continue to dump a lot of cash and are living longer? If such a double whammy happen, right? Then because we live longer, we have more money, we will just dump it into CPF, and then government say, "Wow, now everybody is living like 90 years old." Then how? Then they will maybe will change the payout age to maybe 75, starting from 75, or they may reduce the payout. I don't know. Like this kind of policy change, you cannot rule out, because you don't know how long people will live.
Yeah. But still, I think that in terms of timing, right? Let's say if this thing is already they already plan to do this for some time, I have to give credit to their timing. What I mean is that if you compare current, let's say, interest rate, right, versus few years ago, right, actually now it's still considered high. Like for example, let's say you are 55 years old, you now instead of 4% you earn 2.5, right? You go outside, you still can get to like something that's close to 4%, right? For example, like UOB saving that Eric you mentioned, right? That's quite decent, and that one of course there's a cap lah, but other investment isn't that bad. But just imagine 2 years back if they make these changes, right? Essentially, you are forcing people to downgrade to 2.5 and you can't get even 2.5 outside. So that's even worse, right? So I think they make the timing wise, I think they make the right decisions to do it now lah, because it will be a lot harder to pull this trigger. Let's say if interest rate come down, and interest rate will come down lah. At least on the US side, Fed already say that they plan to cut interest rate by end of the year. Definitely will see some movement lah. Then people will get shocked one more time. I thought that I put money on US side can earn, like let's say US government bond, right, also can earn quite decent yield now. Then suddenly they drop the interest rate. Oh, disappointed again. And want to convert the US dollar back to Sing. Oh, US dollar weakens. so many things can go wrong.
Eric just now mentioned about this increasing of the 70 years old to 75. That one I think is actually, it feels like very likely to happen, that given that the mortality rate increase, the CPF life payout going down is, I'm quite certain it will go down, because people are living longer. And they already said that it will happen. It's on their website already. They say if more people live longer, we will reduce the payout. So this is a certain thing already. The next thing they could target is the basic plan, CPF life basic plan. So this thing, right, so there are three plans, right? CPF Life, Standard Plan, Basic Plan, Escalating Plan. So while the Basic Plan gives lower payout, right, the interest that you earn actually goes into RA itself. Whereas for Standard Plan and Escalating Plan, the interest goes into the CPF Life pool. So you can say that the interest doesn't actually belong to you after 65. But for Basic Plan, right, the interest still belongs to you. So if there's anything to fix here, I guess it might be the next thing to fix lah. So there are three plans, three different kind of payouts. The one that Mr. Lu showed just now was the Standard Plan, where you get higher monthly payouts. Or you can go for the Escalating Plan, which starts lower but increase by 2% yearly. This plan is actually very bohua lah, unless you think you can live like past 100 years old. Because to even get the same payout as Standard Plan, your Escalating Plan, you need to live till like 70 years old, 76 years old, is just to have it be higher than Standard Plan lah. Then for Basic Plan, if it gives you slightly lower money payouts, maybe like $100-$200 lesser, right? But in return, it gives you the interest will be credited to RA. So, so what you think is lost from CPF asset is still happening in the basic plan lah. He from investment mode did a whole analysis on this lah. So basically, he found that basic plan gives you the most payouts compared to the three lah.
I want the most 五花 one, like
basic plan lor.
the most 五花 is basic plan, right?
Yeah.
So the rest, can I just check? It will go into your OA, and then we actually can withdraw it out, right? When we reach 55.
Yeah, I think you are referring to the FRS, the full retirement sum. So there are two separate things. The amount of money, full retirement sum, anything above the full retirement sum gets transferred back to OA, or you can top up to the enhanced retirement sum to get higher payouts. But this one is the standard basic plan, escalating plan is the kind of payouts that you want. Lor.
Yeah, but on my side, I would say definitely all these things will keep changing. So I'll still come back to the same point, which is that government can do their things, they can structure different things. You, as a future retiree, you need to plan and you need to read all these games so that you can play it well. But at the same time, don't 100% count on all these government scheme and policies. Definitely still, it's a lot better to have the bulk of your net worth outside of CPF so that you have the full control, and you need to learn how to manage that pool of money rather than depending on some other entity to manage on your behalf.
And with that being said, remember to like, share, and subscribe. Okay, bye.